Welcome to Cup of Bull. I'm Patrick Fontana, joined by our Director of Planning, Michael Dunham.
Cheers.
Today's episode, we're going to tackle 4 fatal symptoms of investor irrationality.
I'm looking forward to it.
All right, so the way we'll do this, I'll run through the 4, and you can give a little explanation of what each one of these is.
Okay.
Number 1, defining money as currency instead of purchasing power.
Yeah, so I'd say we most commonly see this with somebody who is overly conservative. So a good example would be somebody who, maybe they inherited $1 million 30 years ago, right? And they came to us today very proud of themselves because it was still worth $1 million. Well, what they're not considering is the loss of purchasing power over those 30 years. So while they still show $1 million in their account, they've actually lost 60% of their purchasing power. Said another way, they can buy 60% less than they would have been able to buy 30 years ago.
So you got to stay ahead of inflation. Number 2, responding to capital markets procyclically instead of countercyclically.
Yeah.
Confusing words.
Yes. Well, I'll use a simple analogy then. So the analogy I like to use here is Black Friday, right? So when Black Friday happens, what do we do and why do we do it?
We go buy more stuff because it's on sale and it's cheap.
Yep.
Go shopping.
So when the market is down, what do we do versus what should we do?
People get scared. They sell their investments.
But they should look at it like Black Friday, right? If the market is down 20%, everything is on discount. And if we have the money and it makes sense within our financial plan to go buy more, it's a great opportunity to do that.
Absolutely. Number 3, loss aversion. Losses feel twice as bad as gains feel good.
Yeah, so Richard Thaler, Nobel laureate, he's the individual that championed this idea, and it's exactly that. So if you think about making money is great, losing money is twice as painful. So we become much more emotional, much more irrational whenever we see the value of our accounts go down, because it's much more painful when we feel that versus the opposite when it goes up.
Number 4, people can't distinguish between temporary loss and permanent decline.
Yeah, so we've got we call it our red dot chart that we show every client consistently, and it just goes over a very simple fact that is every single year the S&P 500 has been down. There's never been a year where the market doesn't decline. And if you're a long-term investor that understands during the year,
right.
So if you're a long-term investor that understands that and is willing to ride out those temporary declines that every single time the market has ended up coming back, that's how you avoid making those losses permanent. Going back to what we were talking about before, though, it can be very tough, and that's where you need to be mentally prepared, and you need to have a plan in place for what am I going to do when that happens. And we would say do the smart things, not the emotional or reactive thing, which is easier in the moment.
Okay.
So now that we've gone through the 4 symptoms of investor irrationality, I want to talk about maybe 3 anecdotes or 3 shots of penicillin that somebody, when they experience any of these, may be helpful to be reminded of.
Do we have the serum?
Yeah.
I have a reminder on my mug of 3 things that I consider the theorem, or the serum: faith, patience, and discipline.
Yeah, so let's break them down. So let's start with faith. Tell me a little bit more about that.
So I just say faith in the market, faith in the great companies of our country and the world, faith in the future. I am a big believer in optimism is the only realism, and that's having faith.
Awesome. So the next one is patience. Let's talk about that.
So sticking with things, right? Having the patience to stick with it, those red dots, to stay with the investment, to be patient and give it a chance to come back and to rebound, having good behaviors when you do that.
Okay. And then the last one, discipline, excuse me.
So discipline, I like the idea, the terminology of dollar cost averaging. Every month, every paycheck, when you contribute to your 401k or you put away automated savings, that's discipline, sticking with it every single time. Discipline. Rebalance, add money, do smart behaviors. So faith, patience, discipline is the way to kind of counteract the irrational behaviors that people do.
Awesome. And if you're watching this and you're not familiar with our practice, I'll let you know that those three words are the mantra of our firm. So we have a one-page financial plan. That's what we do with all of our clients from a planning process standpoint. And there's three columns on that plan: a faith column, a patience column, a discipline column. Those three things are the key to achieving any goal, in our opinion. And so with that,
Patience, discipline.
Patrick, thanks for teaching me about
Money.
There we go.